back to the Functional Retirement Podcast. I'm your host, Thatcher Taylor. I'm here with Bob Gavlak. As usual, we met over social media, but advisors are cut from a very similar cloth, so we usually get along really well talking about retirement topics. So today we're going to talk about life insurance and annuities and retirement planning, because at this point, with all of our information pretty much coming from social media, we got to dispel some myths. So Bob's a master of both. Hey, Bob, thanks for joining us.
Hey, Thatcher, I appreciate you having me on here. Looking forward to the conversation.
Yep, absolutely. So, Bob, you do a little bit of both. You do some financial planning, retirement planning like me, but you also do some insurance and annuity products when it fits a client situation. So that's what we're going to try to do today. We're going to try to find those places where this stuff fits. But before we move on, take a couple minutes, tell everyone about you, how you got to where you're at, and get people a little bit excited about what we're going to talk about.
All right, sounds great. Well, I started in the industry, I guess at this point it'd be 14 years ago now. So started at a pure financial planning firm that was focused on teaching and showing me the right way, and their opinion and now my opinion of approaching a retiree's planning, right? And that's building the plan first and then implementing the products or solutions afterwards. I spent 3 years there, moved to an RIA in Cleveland, Ohio, and then a few more years there, moved down to Columbus, Ohio. Now own my business, have a book of clients that are mine and I take care of. And the approach that I take for any of my clients, whether they're coming up to retirement or just kind of starting out, is building that financial plan, understanding first what are their goals, what do they hope to accomplish, what are their resources. Then looking at it and saying, hey, what direction do we need to take this? And then finally implementing what the solutions need to be. So Thatcher, I've heard you talk about it all the time of, we want to look at the goals first, build the plan second, and then implement the solutions third. We think about that with investments. We think about that the same way with insurance. I think too often it gets overlooked. It gets, or it gets a bad rap because, hey, insurance, somebody's just coming here in an ill-fitting suit to sell me something, when in reality, insurance is super important to making sure that we protect ourselves, protect our loved ones, protect our families from things that we can't control or that, we know are going to happen at some point in the future with, life insurance. So try to do all the planning to make sure the policies fit, as opposed to, hey, this is the best policy ever, let's just force it into everybody's financial plan.
Yeah, that's awesome. We definitely do share a very similar mantra with the goals, planning, assets, because it's really important. You got to understand what you're utilizing specific products and services and strategies for, because I've seen both sides. I've seen where they only want, or the company that I work for wants, life insurance and annuities to be sold. It really, any situation, just can you find out if that product is suitable for the client's particular situation? That's what they're looking for. But I've worked for Vanguard on the other end of the spectrum, where if you mention life insurance or annuities, they light you on fire at the stake because it's very taboo. You don't need any life insurance and annuities. We're a total return approach. Don't even worry about that type of stuff. But when you get out in practice, there's a place usually in the middle. And so what we're going to do today is we're going to follow that mantra: goals, plan, assets, or in this case, goals, plan, life insurance and annuities, because we're not going to talk a bunch about investing today. We both do a lot of that. We both manage assets. But we're going to talk about insurance and annuities and how it fits in particular retirement situations. So as we get into retirement, there's some things that people want to talk about first. About, you don't need life insurance when you retire. Let's start there. Tell us a little bit about the mentality of people that are coming in retirement where it says you don't need life insurance.
Well, it's funny. I just had a client meeting last week, and what the one gentleman told me sitting across, he's like, my dad always said that life insurance is for people who can't afford to die, right? So you're, trying to protect from, hey, I won't have this income, or I don't have the assets. I want to protect my family. And when we get to retirement, the hope is that we have enough assets, or a client, whoever it may be, has adequate assets to cover what they need for however long they may live, right? Whether it's to 80, 85, 95, 105, right? Like who knows, depending on how well you take care of yourself and all that. But life insurance can do a lot more than just protect from, losing an income, which is what we think about, especially early in life, to pay off the mortgage, whatever it may be. A lot of people use it to look at it for like a legacy for kids or for grandkids. Maybe, hey, if you have $1 million, but you want to leave $500,000 to your kids, well, you have two choices. One, you either spend less so that you make sure when you pass away, there's 500,000 left in your IRA or whatever it may be, or you buy a $500,000 life insurance policy, and then even if you spend your investments down to zero, that your kids, your grandkids, whoever you want to leave something to, charities, that there's something there and available to you. So, I think there's a lot of examples. That's just one to kind of kick it off and start it off with. But certainly there are situations where life insurance can make sense, even in retirement, for just about anybody, but it's about that conversation.
Yeah, absolutely. That's a big one that a lot of people don't really want to talk about too much, especially in the fee only space, is the idea of, well, it's a newer idea of the idea of spending to zero, where retirees are getting more comfortable with the idea of, as opposed to leaving assets to heirs, they want to spend as much as they can. That's becoming the new popular thing. They want to enjoy their hard work, which I get. And so life insurance could be a supplement as long as the cash flow can handle it, where
Correct.
the beneficiaries will still get something even if you spend your assets to zero. So we'll come back to that, but I think it's important for everyone. We've mentioned life insurance a couple of times. Let's filter it down a little bit. So there's life insurance in basically 4 forms, and you can add or pull some of these out in the way that you view it. There's term life insurance, which is pure insurance.
Yep.
There's universal life that's broken up into kind of 2 categories, fixed and kind of variable universal life. And then there's whole life. And then from there, there's obviously a bunch of different varieties, but those are kind of the main versions. Give us a little breakdown of all 3/4 of those, if you wouldn't mind.
Sure, absolutely. So term life insurance, as you mentioned, is just pure insurance. That if there's a legacy goal or something you want to make sure that insurance is going to be there when you pass, term insurance is probably not the best bet, because the purpose behind it is, hey, it's here for 5, 10, 15, 20 years, whatever the term is. And then after that, it's gone. So if you're, 60 years old and you buy a 20-year policy, if you want that policy to pay, it's not a good thing to hope you die before 80 to make sure that pays, right? So term insurance tends to be the cheapest form of insurance. This is usually what, younger folks are encouraged to buy when they're just starting out. They have kids, they have a mortgage, they want to make sure it's there if kind of something awful happens. But that's kind of the base term insurance there. Universal life can, actually, I'll jump to whole life first, right? So whole life is designed to basically be there paid up to age 100, right? So it's like the Cadillac, the highest level of guaranteed life insurance. And all of these, what I would call permanent policies, which would be whole life and universal life, are designed to, as long as they're paid into properly, as long as you pay the premiums, be there whenever ultimately we, find ourselves waking up on a cloud, right? So they're permanent insurance products. They're going to be more expensive than term insurance because in this case, the insurance company knows that they're going to have to pay out a death benefit at some point in the future. Whereas with term insurance, I want to say 98% of them never pay out benefits. So it's much cheaper for term insurance, but whole life insurance, universal life insurance, they can also have what's called living benefits, where you build up like a cash value inside. To just keep it simple, Thatcher, I'm not even really going to talk about those benefits today. Unless you want to dive into them, I'm happy to. But I think that too often that sort of piece of life insurance is oversold to say, hey, you can get tax-free income in retirement, when that depends on a lot of different factors that again, may overcomplicate the conversation for today. But whole life is designed to be there as long as you pay the premium. Universal life is designed to be there. And again, it can be variable or indexed. There's guaranteed universal life, but those can be subject to some market risk depending on what you have tied to the crediting index. But also like the fees and the charges inside of those policies can change over time. So they're a little bit less guaranteed than whole life, but they're certainly, better than, term insurance. So, I know that that's a pretty broad brush there, but is that a good start there, Thatcher? Or is there anything to add that, to kind of fill in the gaps?
No, that's great. I'll fill in a couple gaps and then you can even add a little bit further because I think it's going to play into where we're going to go with some of these examples about finding the right product that fits the right situation. So for each one of these life insurance policy types, there's going to be some sort of premium. The term premium based on your age and your health and the death benefit amount is going to be cheaper than the same age, health, and death benefit amount for a permanent policy. And the most expensive one is going to be most likely the whole life policy.
Correct.
For those permanent policies, the universal life and the whole life, that cash value that you mentioned is one of the reasons why the premiums are a little bit more, because the term does not have any sort of cash value. I know there's some term policies where they might, if nothing happens, they might pay you your money back.
Yeah, like a return premium or something.
Yeah, that's a feature for another day. But we need to know that premium is really important because you mentioned something along the way. As long as you pay those premiums, because these are sold improperly in the idea that you can take loans against them for income, or you could pull cash value out and use it with a surrender. But those are from your premiums that have been paid in based on the performance of the underlying cash value. And the reason I say that is because the performance and the cash value of a whole life is just based off dividends and interest paid from the insurance company itself.
Correct.
The universal life policies, if it's a variable universal life, is based off the performance of the sub accounts. And if it's just a universal life, like an index universal life, is based off an index, or if it's a different type of universal life policy, it's based off the performance of the company in itself. So these types of policies matter as we build out which one you're going to use for any potential goals in retirement. So let's start with term first. The majority of the people I work with are going to be around age 40, 45, 50 and up. When in those situations would we use term policies as we get closer to retirement? And if there aren't any, that's fine. But give me some examples of when we might use a term policy.
Cool. So, I think for Thatcher, for the folks you work with, especially if they're in their 40s or 50s, term insurance can make sense just to bridge the gap in case something happens from today until the point at which they feel they're going to retire, their goal retirement day, right? So, say you have a 52-year-old couple, one of the spouses makes significantly more than the other, and they want to retire in 10 years when they're 62. Well, what happens if that, high earning spouse passes away at 54, right? Like, and then all of a sudden the other one is left like, hey, the breadwinner, so to speak, has passed. That's where term insurance can make a ton of sense. Whereas if they're still both working, they're still both there to age 62, they're going to be on that path to a successful retirement. But if something that quite unfortunately is outside of our control happens, they pass away, that's where term life insurance can make a lot of sense. But you have to pick the right term for that circumstance, right? So it wouldn't make sense to buy a 20-year term policy in that circumstance. All you really need is a 10-year policy for that situation, right? So I think that's an easy one, or if there's, just a mortgage that they just want to cover, right? Just in case. They don't necessarily need to, but, they just, the one spouse wants to be able to pay it off, and it's going to be paid off in 10 or 15 years. That can absolutely make sense. And again, term insurance, very affordable relative to the other ones. But, that's those tend to be the situations where it makes the most sense.
Yeah, I think so too. The only other thing that I would maybe think of is maybe starting a business, something like that.
Mm,
But we just think of term in whatever situation you're in, even if it's coming into retirement, is income replacement. So
mhm,
say you're 65 or 70 and you're in retirement, and you have assets accumulated. You don't need to really replace income because the assets are there for the income. And if anything happens to you, those assets, say their IRA or taxable brokerage accounts or homes or whatever they are, those will pass to heirs as long as there's balance and money remaining. So the
mhm,
value is not as important. The income replacement with a term policy is really important. So I think that's a good example. So let's go over, you talked about whole life. So whole
mhm,
life, interest gets paid from the life insurance company. You have a really big premium, but
mhm,
that thing functions and operates properly for a long period of time as long as you just keep paying the premium.
mhm.
So tell us a situation where we might need to use this. And before you even get into the situation, just know for the listeners, you still got to pay that premium unless you buy some sort of big paid up policy where you just dump a bunch of
Correct.
money in
Mhm.
right up front, but you still got to pay that premium. So this is part of the evaluation for retirement of your income distribution strategy, because now you have another expense that you got to
Correct.
maintain all the way through retirement. So after we make that assumption, depending on how much it costs and your age and your health and all these types of things, tell us some situations where that could make sense.
So whole life, I think, it is again what I would consider to be the Cadillac version, right? Like the high end version of permanent life insurance. If you want to make sure that a death benefit is going to be there no matter what, given Armageddon going on around us, whole life insurance is going to be the most guaranteed that, hey, these policies are going to be here as long as you pay that premium. Where there is, again, some variability, some now, depending on the build out of the universal life, you can still have guarantees to certain ages, but whole life is designed to be there regardless of market conditions, circumstances. So if, there's this goal, like we mentioned earlier, Thatcher, of I want to leave X number of dollars to my kids or to the school that I went to or to my church or to my grandkids, whole life is going to be the most guaranteed way to make sure that that is going to be there for that use in the future.
Yep, absolutely. And we should tell her, we haven't even mentioned this, but the death benefits from life insurance policies in general, and literally probably the majority of the cases is tax free as well, where
Yep.
the money gets
Yep.
distributed tax free, which is why we're talking a lot about giving it to heirs and giving it to other places that might be valuable because it's completely tax free, which is really an interesting way. So with
Mm-hmm.
the whole life, which this will be a good transition to the universal life. Some of the
Mm-hmm.
big concerns that people run into are being told that you can use the cash value to live on and distribute in retirement, which is true. Like the nuts and bolts is true.
Can
You
be
can
true. Yes.
surrender money out of your policy or take loans out of your policy and use that money. And if anything was to happen to you, basically that would just be reduced for your beneficiaries. But we've talked about how making sure these things function for the long term. But
Mm-hmm.
doing those moves of pulling money out of that cash value can really be detrimental to the policy. Now, how often do you see that with whole life policies, and how big of a concern is it with whole life specifically?
So whole life is going to have, when it comes to guarantees with the death benefit that we talked about, they're also going to have much stronger guarantees with their cash value, right? So because it is paid via dividend from the whole life insurance company itself, they tend to be much more stable and much more in line with what we call the illustration when the policy is initially sold, right? So when if 20 years ago somebody was sold a whole life insurance policy and they were shown an illustration for what it should look like 20 years from now, the thing with these whole life is that they tend to be pretty close to what was illustrated, right? Now, some of the dividends have come down for some of the companies, but for the most part, they've been pretty consistent over time, which is another reason it's kind of the high end, right? Because it's this consistent dividend. It's not subject to market fluctuations. Um, but certainly, as soon as you dip into that, so say you have a $500,000 policy and it is $100,000 of cash value, the premium that you pay over your life is consistent, but that's because eventually the insurance company, as your insurance costs go up, eating away at that cash value on the back end, because the insurance cost is paying out of both your premium and also pulling from that cash value. So if you just start taking from it without consideration for what will happen long term, you could run into where either A, you have to increase your premiums back into the policy, or B, reduce the death benefit of the policy, or worst of all, C, the policy lapses, and then there's no life insurance, there's no death benefit there. So you just need to be careful when it comes to, accessing these living benefits. And now a pure insurance guy would just be like, well, you just need to make sure you do the proper planning, right? And you run the right models or whatever. But at the end of the day, we need to understand that these policies have pros and cons, both the death benefit and the living benefit. And it's important to look at it, Thatcher, and say, what's most important to me, to my family, and not looking at this like it's going to solve every problem or an answer to every solution for you from a long-term perspective.
Yep, that's exactly what I was looking for. So life insurance policies, just to dive in a little bit deeper on that, life insurance policy, well, when they underwrite you for a life insurance policy, I should say, they get you a specific health rating, and based on the death benefit, that provides the premium amount.
Mm-hmm.
And that amount of premium, part of it goes to the cash value, like I mentioned, and the rest of it goes to the cost of insurance, the amount that it costs to insure you based on your health and your age. These things matter because every year that you get older, the cost of insurance goes up on these permanent policies. Every single solitary year, the cost of insurance goes up. So if you get this policy in your 50s, the amount of insurance that it costs in your 70s or 80s is substantially more. So that's why the cash value in the whole life policy matters, and the consistency with the dividends that pay in is because as that you pay in the premiums, a portion goes to the cash value, so that accumulates, but the dividends accumulate. So that ratio on the illustration you mentioned is very consistent. As long as you pay the premiums and as long as the dividends stay around here, this thing's going to function fine. The reason I mention this is because if you were to take money out of the cash value in your 70s or 80s, that's when it gets really dangerous, because you're not putting enough in to cover the cost of insurance, because the cash value down the line is what is the excess that covers the cost of insurance.
Exactly.
So I think this is a really good transition to go to the more, I don't know if we should say risky policies, but the more complex universal life policy, which full disclosure, I just used a variable universal life for a client in an irrevocable life insurance trust just a couple of years ago. They're younger. They got a long time horizon. We're using an S&P 500 sub account. We're dumping a ton of money into it. So I'm not anti-VUL, but we got to monitor it closely, and we're not ever going to pull any money out of it. So using that same example, the whole life, but now we're going to transition to universal life. Universal life is not getting dividends paid from the insurance company. They're utilizing sub accounts, which is basically just a mutual fund, or they're using basically credits or from the general account of the insurance company, credits into the universal life. So talk to us a little bit about the differences of those and when they would fit in a retirement or a pre-retirement situation.
Sure. Well, I think you just shared a really good one with the VUL and the irrevocable life insurance trust, because that's going to provide the death benefit, right? That's going to be there. And also, nice thing about the VUL is it has tax deferrals built into it, right? So as it grows and as it continues to appreciate over time, there's no tax that's going to come and be taxable to the trust in that situation, which would create income and just stuff you don't want to deal with the ILIT.
Or in any trust, for example. I mean, it's kind of a hybrid for an individual where we're kind of utilizing all the retirement buckets like IRAs, 401ks, if you can, or taxable brokerage accounts. But if you're in a high income space and you're using a taxable brokerage account, you're most likely going to get more taxes on a year-to-year basis. So where the VUL plays is you can add money into it on a consistent basis, and there's no taxes on a year-to-year basis. It's deferring them long-term, and you can utilize like a sub account of the S&P 500. So you're getting good growth. You're just deferring taxes for down the road. But yeah, continue.
Yeah. So, and then of course, and we won't even necessarily dive into annuities. We may, right? But, a variable annuity would do very much the same thing. But the VUL has the benefit of the life insurance associated with it. So effectively, you're leveraging it up to say, hey, if something happens in the short run, we're covered. But long run, we kind of have this nice sub account. The universal life policies, as you mentioned, a lot of them, indexed universal life is something that I use quite a bit. That Thatcher, you mentioned it, and people may have seen these before, where they're like, you have, if the S&P does, a certain percentage, you're capped at 11%, but if the S&P goes down, you effectively get a zero, right? So there's like downside protection. These crediting buckets, the way that they're designed, and a lot of times it's sold like, hey, you can have this appreciation with downside protection. So why would you not just dump everything into this indexed universal life insurance policy? Well, the issue there is that, yes, you're avoiding the downside, but your upside is capped, right? So, even if, if the markets go up, like this is a good year so far here, Thatcher, right? And if they go up 20, 25% and you're capped at 11, it just costs you, 9 to 14% to be in a universal life policy, right? So, but there's more variability just in the way we're talking about it here quickly, Thatcher, right? Like in the whole life, we're just like, they pay a dividend and that's it, right? With these universal lives, it's like there's all kinds of different ways that they can approach the crediting rate, and that can impact your living benefit. But there's still that death benefit that's associated with all these universal life policies. And what I try to look for is, how long is this policy guaranteed for with maximum charges, what we have to look at, like inside of the policy, max charges and minimum crediting rates, and see how far the policy goes. Because for a lot of them, especially ones, and we mentioned it earlier, like a whole life policy that was sold 20 years ago, it's probably performing in line with what was expected. But 20 years ago, these indexed universal life, variable universal life were being assumed to have 9, 10, 11% crediting rates, and they're way behind. And now there's a really good chance that, your cash value is not where you want to be. You need to pay in more premiums to keep the death benefit. You really need to be mindful of, how is this policy performing, and does it still make sense for the plan? And that's why this whole planning conversation is so important, to understand, what do we want the insurance to do, and not just say, hey, this is an amazing product, let's fit it in there and shove it in and just make it work.
Yeah, so good. So many pieces I want to take out. Let me make sure I get them all out. The first thing is, you're right about the policy illustration showing the proper metrics when they're being presented to the client, because that's what VULs or let's say, talk about universal life right now, is they have that cap. In the past 2 years is the perfect thing to describe what happens in a VUL and how they sell it. Last year, the market was down 20%. This year, it's already up almost 20%. So this is what the salesman of the universal life will talk about. Last year, if you put in, let's say, $100,000 on January 1st, 2022 into the S&P 500 ETF, at the end of the year, it'd be worth 80. But the universal life policy will say, well, you'll put in 100 and there'll be a downside cap of, let's just say 0. You'll come at the end of the year and you'll get a statement, and they'll say, although the market was down 20%, your statement says $100,000 still. But this year, the market's on a tear, but there's an upside cap where if the market finishes up 20%, they're not giving you 20%. They're maybe only giving you 10 or 11, and the insurance company is going to retain that. So then people are going to ask, well, how on the downside are they going to say that I didn't lose any money? Well, they do it with a surrender period, right? So if you wanted that $100,000 back at the end of 1 year with a downside cap, you're not getting $100,000 back. You have to surrender it, and you're going to get less. And that's going to be the cost. So that's why
Yep.
they keep you in longer. And that's what you're talking about in the illustration are those caps. Because outside of those caps, there's still charges and fees that are associated with a policy. So if an insurance agent is showing you a policy with really low fees because they want to sell it and really good caps because they want to sell it, they could be setting a bad precedent where if they don't perform over a period of time, that client's going to have to do what you said the three options were, where they're going to have to surrender it, or they're going to have to add more money to it, or what would be the third option?
Just lower the death benefit, right?
Lower the
So, you know,
benefits of
yeah.
the in this case, like the annuity or life insurance policy. So I
Mhm.
think you really hit the head on something and what people are overseeing when they come to getting sold an insurance policy as a quote unquote investment.
Well, and Thatcher, just not to toot my own horn too much, right? But like this is
Toot
some
it,
of
man. Toot
yeah,
it. Let's
right.
go.
Let's go. So this is where a lot of the bad name for insurance comes in, right? You get an insurance salesman that walks in that sells this fancy product, right? That says, hey, it's going to do all these incredible things for you. You just got to wait 10, 15, 20 years. But they're not there in 10, 15, or 20 years to answer to whether or not this policy performed the way that they promised, because they're just selling a product and moving on to the next person they want to sell it to. For me, when I look at it from my clients, it's like I expect to be there in 10, 15, 20 years. So I need to make sure for, my protecting me and my interest in my business, but most importantly, protecting the client and getting them what they want out of their plan and out of their money, that this thing is going to perform the way we want. So, when we run it, I want to run it with conservative estimates, right? I want to be like, hey, let's assume this thing doesn't perform at 8, 9, 10%. It only does 4. Is it still going to work the way that we want it to? And that's why when looking at the guarantees of truly what happens if everything just goes to, crap, right? How is this policy going to be there and how is it going to help us accomplish our goals for whatever it may be. And I do have one use case that I love to share, Thatcher, that I want to dive into, but is there anything else to add on that piece before I kind of jump into another use case for retirees utilizing these insurance policies?
Yeah, I think that's good. The only thing that I wanted to add is when you're making this is for clients that are trying to decide between a VUL and just investing in the market,
Mm-hmm.
where the main selling point of just investing in the S&P 500 ETF or using a VUL or a UL are those, well, I guess you should say VUL, the universal life, not VUL, the universal life is that downside risk component. They're really saying that the UL is going to protect your downside risk.
Mm-hmm.
Where when you're comparing whether or not you need a UL, universal life, versus you just are going to take your 100 grand or $1 million or whatever it is and invest it in the S&P 500 ETF or a balanced portfolio of some sort. And again, just I'm not recommending the S&P 500 ETF if you all are listening. I'm just using it as an example.
Yep.
But if you can withstand the volatility, like you can come January 1st, 2022, come to the end of the year, you're like, oh, it's down 20%, no big deal. And then wait and give it more time and look back, okay, yeah, there's just volatility. You think long term, if you assume that the market is going to do well over long periods of time, the downside cap in a UL sometimes doesn't really fit the bill. It doesn't produce what you think it does if you can just withstand the volatility and stop viewing the market as risky, you may end up in a better situation anyway. That's kind of just what I wanted to add as people start to make the decision about ULs versus maybe I should just invest it and have a money manager kind of watch after, like those types of things come into play. But that's the kind of the last thing I wanted to add for sure.
Absolutely. Yeah. And that's a huge consideration. In general, don't like to recommend to clients to utilize any sort of life insurance or annuity as an investment vehicle, especially if they have a long time horizon and they can deal with the volatility. But it can make sense. One of the things you mentioned, high income earners, right? It can be if you've already maxed out all your stuff and you're trying to insulate from some taxes, that can make sense. But certainly if you've just got a chunk of money. There's extra costs, there's extra fees, there's extra restrictions associated with life insurance that 9 times out of 10, it's better to just invest it and utilize traditional investment strategies. So,
yeah, I agree. In fact, being even more deliberate, any sort of growth potential, I wouldn't use a UL, a universal life. If there was a really high income earner that needed something outside of like a taxable brokerage accounts and were maxing out their 401ks and they had extra money, would maybe do a variable universal life. That would potentially be an option just because of the S&P 500, the sub account capability over long periods of time, and the tax deferral. That although there'll be some additional costs associated with the policy, the tax deferral savings would help compensate with that. So that's where I would go. But universal life, very rarely going to be used, but variable universal life would be more probable in situations like me, but that happens very rarely. I'm more of a market optimist. Like, let's lower the cost.
And
The majority of us, you just need to invest in a high quality portfolio, have good behaviors, and keep adding money to it. And then we'll go from there. But give us your use case. Talk to us a little bit more about that.
Yeah, so one of my favorite use cases for retirees and life insurance is something called pension maximization, right? And so, if any folks listening or any clients, they have a pension and they're coming up, getting ready to, or thinking about, hey, what do I want to select for myself and my spouse for when I retire, right? And their options might be, take the single life payout and it's $3,000 a month, or Thatcher, I can take the joint and survivor payout for me and my wife, right? But it's only $2,200 a month or something like that, right? And that's a huge decision when it comes to taking your pension. Now, effectively, all the pension company is doing in that situation is saying, hey, we're giving you $800 less because we're ensuring that this income is going to be there for both your life and your spouse's life, right? So if instead we look at it and we do some planning and say we can get, and I don't know what the dollar figure is exactly, right? But say that we take, we can get a $500,000 life insurance policy that more than covers the difference, and it only costs $400 a month. Well, now I can take the single life payout. I can pay $400 to the insurance company on my own, and I still know that my spouse is protected. If I pass away, that $500,000 is going to go to him or her to protect them, right? So I've paid. It's cheaper for me to do it that way. And by the way, if you take the joint and 100% survivor payout and your spouse passes away first, well, more often than not, there are times when it'll come back up, but more often than not, you're stuck with that lower payout for the rest of your life. Whereas if you took the higher payout and pay the insurance, then you can decide, okay, do I want to keep the insurance for maybe my kids or my grandkids, or do I just want to cancel it? And now my, payout goes back to effectively the $3,000 a month. So really it's ensuring on your side of the table for maximizing your pension options versus taking what the pension company is offering you from a payout perspective. So now all of this depends on your age, your health, your insurability, how much you need in order to cover that difference. But it's something that with any of my clients that have pensions, we walk through and we work through to say, does this make sense? And can we put the right policy in place to make this work?
Yeah, I think that's a great idea. Because what you're saying is, if you take the joint life that was 2,200 versus single life that's 800, that difference, if you take the single life, so you would choose the single life, that difference, so you're getting paid $800 more than if you went with the joint life, you would use that to pay the premium on some sort of policy. So all you'd have to do is run the numbers, kind of the break even, like, okay, so say that $400 or $500, put in a policy, what would the death benefit be? Or what would that $500 be if you just put it in, again, S&P 500, ETF, whatever. And you just have to balance that with a future value number and that death benefit and find kind of that break even and be like, which one makes sense? And if the life insurance makes more sense, that death benefit is bigger. That's a great way to make sure that your spouse gets a little tax-free boost right
Yep.
at the end of it all if you happen to pass away early. And a lot of things that come into play with this that are really cool is if there's a big gap in age between you and your wife. We see this a lot where the husband's 4 or 5 years older than the spouse, and the
Yep.
wife is the spouse is predominantly going to live longer. So there's a lot
Mhm.
of things that come to play. That's a really good idea. I've seen that in practice, and that could be a really good example. And then obviously health, make sure you're in good health, like
Of
that type of
course. Yeah.
stuff
And
too.
with all of this, right? So I used to teach classes, Thatcher, and I would share this during the class, and people would be like, "Yeah, Bob, I'm going to go elect my, single life annuity payout, or single life pension payout, and I'll get the life insurance done." Don't do that, right? Like there's planning that needs to go into it. You want to get approved for the life insurance first, because worst case scenario is you elect the single life, you find out that you've got something that the insurance company doesn't want to give you any insurance, and now you're not protected, your spouse isn't protected, right? So that's why all of this is so important. Again, going back to the plan and building the plan first, understanding your goals, understanding your resources, what you want to accomplish, and then let's do some insurance planning around this and find, if there's a place for it, let's put some insurance in place. But if there isn't, like let's keep moving forward.
Yeah, that's huge. That is literally part of the planning component where you can't go back. Maybe
Mhm.
there's some pensions that you can maybe get lucky and they have some sort of reversal clause. I doubt it. I've never seen that. But
No.
if you pick the pension and you're not approved for the life insurance policy, this whole plan crumbles. So that's the
Yep.
value of kind of starting to think through this early. There's a prospect that I'm working with right now that is basically wanting to retire now. If the company
Mhm.
does another round of layoffs, he's asked to be on those layoffs, like kind of the forced retirement, but he really wants it. But he's done zero planning, where
Mhm.
the planning should have started maybe a few years ago, starting to generate some of these ideas on how to plan properly. This is a
Yep.
perfect example. Like, what do you want out of this? What is the plan? And then what product or assets do we use to support that? So, I mean, that's perfect. That's a really
Exactly.
good
So
idea.
to just piggyback off that there, Thatcher, right? Like that's a situation where term would not be, you would not want to use that in that scenario, right? Like that's already off the table. Whole life is going to
Because you
be,
might outlive it. Because
yeah, you
the
might
reason
outlive
you
it.
want the term is because if you pick a 30-year term, what if you outlive it? It was useless. There was no point to that.
Exactly. So whole life, probably I wouldn't utilize for it either, just because there's all the extra cost that's associated with the permanence of that policy. But a really strong guaranteed universal life that goes out to age 100 or 105 or even age 110, that is fully guaranteed out to that spot, would probably be what I would look at for a situation like that, right? So like bare minimum, very little cash value growth, really just focusing on guaranteeing that life insurance benefit is where we'd go in a situation like that. So that's, again, that's why understanding all the different types, right? The term, universal life, both variable and indexed, but then also whole life, and saying which one of these makes the most sense for this specific situation and going from there.
Yeah, absolutely. And don't be afraid to check out a couple different brokers and agents. Just because you know one, double check a couple, make sure you got the right fit. But I think you're right. Plus, you'll have to go with VUL or Universal Life because they're going to be a little bit cheaper than whole life. So you're really trying to maximize that premium or
Mm-hmm.
that extra $800, for example, in your example. We're trying to
Yep.
maximize that as much as possible. So if you go something a little more expensive like whole life, yeah, it's more guaranteed and secure, but you're not going to get as much death benefit in this particular situation that you may need. So I
Exactly.
think that's a really good example of how you can use insurance in more complex planning as a benefit to you and your family if it fits the right way, as opposed to just, I want to get some insurance to give a tax-free death benefit to my family. That may not make sense if you're 67. It's just going to be wildly too expensive in a lot of cases.
Yep. Correct.
The other thing I want to mention that could be a good idea that if you could try to expand on is using life insurance in business transactions. So here's what I
Mm.
mean. There's a lot of people that are starting to end their first careers early in their
Mhm.
50s, 55s, late 50s. but they're not fully retired. They may start a business or go into business with a partner. That utilizing life insurance in a business situation to protect you in the event of catastrophe with a business partner is a really good method to plan for the business. How much are you involved in that? Have you seen that very often?
Yeah, well, personally, I have one in place, to protect my clients, to protect my wife, my kids, all of that stuff. The most common way is what we would call a buy-sell agreement, right? That effectively, if there's two partners in a business, and if one of them passed away, the spouse would want to be able to buy out the shares, but it's really hard for business owners to come up with the cash sometimes if they're just kind of building this business. So a buy-sell agreement where it's funded with life insurance, that if, hey, a catastrophe happened and the spouse wanted their share of the business, and make sure that the business itself continued as well, that this insurance policy would be able to come in and pay, and get that taken care of. I have it again for me on my life, so that if something, God forbid, happened to me, I don't have anybody that has the money to just buy my wife out, I guess, from my business. But that's where the insurance comes into play. That'll fund the ability to be able to purchase it, and then my wife is compensated, my kids are covered and protected, my business partners are protected, and honestly, most important, well, maybe not most important to me, but very important to me relative to my family, my clients are protected as well. So there's consistency in the business itself, and there's not like some, loss going on there. So that's one way. The other way is, key man planning, key man insurance, right? So if you own a business and you got a partner and you have an employee that is hugely important to the operations of the business itself,
A big
you
salesman, a big producer, anything like that?
exactly, right? Or just even like an operations type person that just keeps everything fit together, right? To make sure that everything's working really well. Whoever's a key person in that business, if something happened to them, it would be a huge hit, whether it's to revenue or to operations or to, whatever it may be. You can get insurance policies on them to, again, protect the business and make sure that, hey, if a catastrophe came up, we can still operate and function as a business, and don't have any hiccups.
Yep, absolutely. And as always, this is another situation. What are the goals of you and your business partner in protecting the business and your familial situation? Because this is something you would want to implement early and as soon as you could, to really start to have continuance and stability in the business in the event of catastrophe. So I think this is a good use case where a lot of people, you may be a little bit older, but you're going into business. But even if you're not, maybe you're in your 30s or late 20s, you have a business or business partner. This is a really good method to help protect your family and the business moving forward. So we're already at about 50 minutes of chatting, which is really cool. So
Yeah.
what we're going to do is we're going to bring this to a close, but I know we mentioned we were going to talk about annuities. So we just got to make a promise. We're going to have Bob back to talk about annuities. This was predominantly was life insurance. It kind of went, there's just so many things to talk about life insurance, but we'll come back and talk about annuities and their use cases and how they play in. But before I let you go, Bob, you got to give us 5 things. I'm going to put you on the spot. I want you to give us 5 things in life that you find most important. It could be financial, it could be non-financial, it could be fitness related, which we haven't even talked about that yet either, but we will. Give us 5 things that people can take with them that they really need to address in their life to help promote growth and success.
Yeah. Well, so, I'll take the easy one out first. It's just family, right? Like number one, most important, having, I'm extremely lucky, blessed to have my wife, my 3 kids, all healthy, all, growing and going their individual ways, right? That is beautiful to see. So family, number one. And with that, as I mentioned, the health piece, right? So Thatcher, one of the things I admire about you and love about you is you're continuing to talk about, hey, listen, I'm a financial advisor, but without your health, without being able to function and move and live, the money doesn't mean as much as it might seem that it does, right? So health is hugely important. I think that for me, one of the important things is a sense of self, right? So whether you get that from, religion, whether you get that from meditation or just, personal introspection, right? Like understanding who you are as a person, as an individual, what drives you, and, ultimately, is what, guides your life, right? Like having that sense of self is hugely important. Being able to have fun, right? Number 4, right? Not taking things too seriously, going through life, having fun. And then 5, always have a good cup of coffee and a good beer available to you if you need it, right? So, enjoying some of those things in life too. So, it's all about balance for everything we talk about. And, that's important to me as I look at my coffee mug over here. I need another cup.
I love it. I love it. And those all nail it, because we can talk a lot about the tangible stuff, the money, the nuts and bolts, all the rules that our government and society puts in front of us on how we're going to build wealth, market fluctuation, how to get rich, and all that stuff is really important. But what's it important for? And
Mm-hmm.
so cultivating all this wealth is really cool. But if you don't have anyone to share it with, you don't have your health to be able to use it, you don't have any meaning and purpose. So you're sitting around angry, upset, depressed, or kind of lost. It kind of renders the money useless.
Yes.
So as we build a lot of these strategies around money, like then almost all the information's already there. Like
Mm-hmm.
there's not really any new strategies that are just coming out of the woodworks. So I feel like it's part of our responsibility as advisors to encourage clients to not only build their wealth, making good decisions and doing the right things, but finding ways to enjoy their wealth is kind
Mm-hmm.
of the missing piece that advisors like us can really start to add value. So I really like how you mentioned all that, the purpose, the relationships, the family. That's really
Mm-hmm.
cool. Yeah, I mean, we're CrossFitters. To end, I think it's a good place. How
Mm-hmm.
long have you been a CrossFitter and had a garage gym? What's it been like? What's your journey like? Do you have any big weight loss stories or any growth stories? Anything that you want to share?
Well, I mean, I'll share my quick background, just what got me into CrossFit. So I was a wrestler, right? All through high school, all through college, was a wrestler. In 2009, I'd just finished up wrestling in college, right? And a friend of mine had set up the first CrossFit gym in Cleveland, right? CrossFit CLE. And I went to school with him. And he's like, you should try this out. And from the minute I tried it out, I was hooked, right? So never done anything competitively, Thatcher. I am not, good enough at any of that to do it competitively. But I've been CrossFitting since 2009. Slowly built out my garage gym at my old house in Cleveland, but then moving down to Columbus, I just got a reminder on my phone that all my Rogue rig and equipment and all that came 9 years ago, right? So I've had for 7 of those years, it was a basement gym. Now I've moved out. I've got 4 acres. I've got a barn. It's now my barn gym. And that's my refuge. My wife knows if I'm ever in a bad mood or if I go too long without being out there, that's what she needs to take me to do. Don't have any huge weight loss stories or anything like that. As a wrestler, my weight can go like this week by week, right? But
You probably didn't want to lose weight after having to cut weight all those years. You're
I
probably
was a
like, I'm
heavyweight
not
in
doing
college.
any weight cutting crap the rest of my life.
Yeah, well, I was a heavyweight in college actually. So yeah, I was one of the big guys. My buddies hated me because I'd get on the bus going to a tournament or a match or whatever. I'd have 2 Quiznos subs and a gallon of water, and they'd be all struggling because they haven't eaten in 2 or 3 days. So that was a lot of fun. But certainly CrossFit is something that for me has kept me motivated, kept me competing with myself on a regular basis, right? Because, as I mentioned, Thatcher, I'm not going out and competing and trying to keep up with, folks like you or just any of the, more hyper competitive ones. I'm just going out there and trying to improve myself, keep myself healthy for, me, for my kids, for my wife, for all of it. It's so hugely important. And, I love it.
That's it. That's it right there. Where did you wrestle at?
I wrestled at Case Western Reserve University. It's a Division III school in Cleveland, Ohio.
I've heard of it. That's cool. And so you were a heavyweight and you wrestled all 4 years?
I did. Yep.
You're like the financial advisor version of Justin Medeiros.
Well, hey, I'll take it, right? I'm happy to. I was certainly not a huge heavyweight. I was just 240-ish, when I wrestled there. So, but certainly with wrestling, a lot of the things that I mentioned, before, and my things to focus on, like a sense of self and sort of that, you're out there by yourself. It taught me a lot about life, about, working hard, working through adversity, staying tough. And I think CrossFit does a lot of that same stuff for you, because it's so different all the time, competing with yourself. So, I love it.
I say it all the time. There's nothing like wrestling. I didn't wrestle. I stopped wrestling in high school because I played basketball. They were at the same time of the year, but I've always admired wrestling. It's a different beast. When you got someone right in your grill all the time, there's a different mentality and toughness and conditioning and physicality that's required. So that's really cool, man. Well, I appreciate you coming on the show. We're going to have you on again for part 2. We're going to talk about annuities. This was really valuable. If anybody who's watching, you have any questions, where can we send you? I'm going to put all these links below. And we connected on Twitter, but we follow each other on other social media outlets. But let everyone know where they can find you.
Yeah, so you can find me on Twitter. You can find me on any of the socials, whether it's Facebook or Instagram or wherever it may be. LinkedIn as well. Our website, wealthsource.com will give you an overview of, who we are and what we do. But however you want to reach out is, fine with me. But at the very least, what I hope for anybody that listened, anybody that watched, that you at least got one thing out of this conversation that you can take and you can ask, whether it's your advisor, or somebody that you trust, to say, hey, I heard this thing, tell me more about it. And, hopefully can provide some value there. So
I think they will. I'm going to put a bunch of show notes below. I'm getting a new website built. So this will go on the new website with an entire article in summary, including the video and the podcast, so people can check it out as well. So when that comes out, I'll let everyone know. But all this stuff will be in the comments below. Don't hesitate to reach out to him. It's wealthsource.com. That's Bob's business. Feel free to reach out with any questions to either him or I. Bob, I appreciate it, man. Thank you so much.
Thatcher, thank you. I appreciate you, man. And we'll talk again soon.
Yep. Thanks for everybody. Make sure to like and subscribe. We'll see you next week.